Welcome back to the deep dive. Now, if you checked your phone this morning looking for the usual price fireworks, you might have been a bit disappointed.
Yeah, more consolidation than explosion, definitely.
Exactly. But look, for those of you expecting your daily briefing, the last 24 hours, well, they weren't really about the price. They were about something, I think, far more important.
Yeah.
Deep, fundamental, structural change happening underneath.
That really is the key takeaway, isn't it? The market's maturing faster than it's necessarily moving up right now.
Right.
That speculative buzz we've tracked before, it feels like it's given way to something more methodical, construction.
Yeah.
The focus has really pivoted almost entirely to building out those institutional rails, getting some genuine regulatory clarity, hopefully, and pushing the tech forward.
Okay, let's unpack this, because that's really our mission today. We want to distill the core forces driving this market maturity, because they seem to be converging right now. We're basically looking at three big movements. First, that institutional acceptance, building the actual financial foundations. Second, the global regulatory environment, which is getting, well, messy and fragmented.
Very fragmented.
And third, that furious tech race happening on Bitcoin's layer 2 networks. So let's start with that first one, the traditional finance world. It feels like they've moved past debating if they should get involved.
Oh, completely.
And now they're actively building the pillars, right? The thesis, the risk management, issuance, security, the whole package.
Yeah, and the sort of intellectual framework for this. It arguably got cemented this week by none other than BlackRock CEO Larry Fink.
Ah, okay.
Speaking at the Future Investment Initiative, he actually grouped Bitcoin right alongside gold, called them both assets of fear.
Wait, assets of fear, doesn't that kind of undercut the whole utility narrative we've been talking about? Like, it sounds defensive, purely defensive.
It is defensive, but that's exactly what gives it institutional cover, you see. Fink's explicitly positioning Bitcoin as a macro hedge, a defense against systemic anxieties like fiat currency debasement, global security risks. He even pointed fingers at the U.S. government's reliance on foreign debt buyers, calling it the biggest issue today.
Right.
So he's pulled Bitcoin out of just being a tech curiosity and dropped it right into the middle of the sovereign debt debate. That's the institutional thesis right there.
And, okay, if the thesis is getting legitimized, the risk management tools have to follow. And we saw a landmark deal on that front, didn't we?
We did. The first interbank over-the-counter OTC options trade involved Bitcoin and Ether between DBS Bank and Goldman Sachs.
Goldman Sachs, wow.
This is significant. It really signals the beginning of a genuinely institutional interbank market for crypto derivatives.
Which is what they need, right,
Yeah.
to handle the volatility.
Exactly. Volatility's always been the big hurdle. Now, by using trusted, regulated banks like DBS and Goldman, institutional clients can finally get the infrastructure they need to hedge crypto exposure. They don't have to rely on, the less regulated crypto-native platforms.
Yeah.
Wall Street's risk management is being imported.
And at the same time, the issuance piece, bringing real-world stuff onto the blockchain, that just got a huge boost too.
Yeah, the RWA sector.
Right, real-world assets. The firm Securitize, they're going public via a SPAC deal. And the valuation, a massive $1.25 billion.
That valuation sets a serious benchmark for the whole tokenization industry. Securitize is notably one of the firms helping giants like BlackRock bring assets on chain. So that $1.25 billion price tag, it isn't just hype. It's based on the market belief that tokenizing global capital markets is a, multi-trillion-dollar opportunity down the road.
So we've got the macro thesis from Fink, the risk management with Goldman and DBS, the issuance benchmark with Securitize. But what about keeping it all safe?
Right, security. That's the final piece of the triad, and the foundation had to be built there too. We just saw the launch of IBM Digital Asset Haven.
IBM?
Okay, and this isn't for consumers. It's an institutional-grade platform focused specifically on asset sovereignty, regulatory compliance, and critically, guidance on quantum-safe cryptography.
Quantum safe? Wow, they're thinking way ahead.
They have to. This infrastructure directly tackles the security and compliance roadblocks that kept the biggest, most cautious regulated players out. So the whole institutional triad thesis, risk, issuance, security, it's now technically possible.
Okay, that structural build-out is definitely encouraging long-term. But let's pivot back to the short-term view for a minute, because here's where it gets really interesting. The price consolidated, like we said, but the money, the institutional money, it kept flowing.
Yeah, the 24-hour action was pretty much classic consolidation after that recent breakout. Bitcoin traded in a tight range, low around $112,075, high near $116,114.
And right now,
it's hovering around $113,000. So a slight dip, maybe 0.5% to 1.0% down on the day, but crucially, it's holding most of those recent gains.
so for you watching the charts daily, holding that current support is pretty key. That zone between, say, $112,000 and $113,500 seems pretty robust.
It does. If the institutional flows keep coming, that range should hold. Now, if it pushes through the immediate resistance, up around $116,000, that could be the signal for the next leg up, maybe towards that $120,000 mark.
Okay, let's talk flows then, because this feels like where the market's center of gravity is really shifting. U.S. spot Bitcoin ETFs. Total trading volume yesterday was $4.07 billion.
Healthy number.
And a positive net inflow, too, $202.4 million.
Decent inflow, yeah. But the concentration within that flow, that's the real story here.
BlackRock's, I bet.
BlackRock's, I bet, exactly. It accounted for $3.06 billion of that total volume.
Wait, $3 billion out of 4?
75.28%. 3/4 of all the U.S. spot ETF volume went through one single fund yesterday.
75%. Wow. What does that actually mean for the average person for price discovery?
Well, it fundamentally changes it. The market center of gravity, it's visibly shifting away from the 247 crypto exchanges towards traditional market hours, dictated by flows into IBIT.
Which means it's more U.S.-centric during U.S. trading hours.
Pretty much. But more importantly, it introduces a kind of systemic risk. When 3/4 of the institutional flow is tied up in one product, well, imagine a large redemption event from IBIT.
Right.
Or even just a technical glitch, an operational issue with BlackRock's custody setup. That instantly creates a massive single point of failure. It could ripple violently through the entire global spot market.
That's a sobering thought. Okay, quick check on network health. Fundamentals still look okay.
Yeah, fundamentals remain strong. Hash rate, that measure of miner commitment and network security, is still really high. 1,093 exahashes per second in NHS.
Good. And transactions.
Network processed nearly 479,000 transactions in the last day. Still humming along.
And the cost to use it.
Here's a good sign for affordability. Despite all that usage, total miner fees collected were actually very low, just 2.98 BTC.
So not congested.
Exactly.
Yeah.
It tells us the network isn't clogged up, transactions stay cheap and accessible for everyone. That's really essential if people are going to actually use it, not just trade it.
All right, moving from flows to, well, friction. Let's look at the regulatory landscape. It feels like it's splintering globally into really distinct regional approaches.
It absolutely is.
Yeah.
You've got the UK, for instance, just solidifying its what you might call the cautious access model.
Right, the FCA.
Yeah, the Financial Conduct Authority.
Yeah.
They lifted their ban on retail investors accessing crypto exchange traded notes, CETNs.
Yeah.
Effective October 8th.
Okay, sounds like they're opening the door, but I'm guessing there are strings attached.
Oh, absolutely. It's more like an on-ramp with a lot of speed bumps. These things are now classified as restricted mass market investments, RMMIs.
Okay, what does that mean practically?
It means firms have to conduct appropriateness assessments. Basically check if the product is suitable for the client. Mandatory risk warnings are required, big bold ones, and no sales incentives allowed.
So access, but very carefully managed for retail.
Exactly. The UK is saying yes, but only under our strict rules for protecting everyday investors.
Okay, now contrast that careful structure with what's happening or maybe not happening in the U.S. The paralyzed oversight model seems fitting right now.
It really does. The government shutdown has effectively shuttered both the SEC and the CFTC. Reports say something like 90% of SEC employees are furloughed.
So hang on, we just had this market flash crash event where some wallet apparently made over $150 million from a leveraged short. Smells like manipulation, right?
It raises serious questions, yes.
And the main financial watchdogs, the SEC and CFTC, they're basically closed for business, furloughed at home. That's just a gaping hole at a critical time.
It creates a really dangerous enforcement vacuum, yeah. Meanwhile, you hop across the Atlantic, and you see the rise of the sovereign curiosity model, particularly in France.
France, what are they up to?
There's a legislative proposal from a French lawmaker to actually create a national strategic reserve of Bitcoin.
A national reserve, like gold.
Potentially. The scope is pretty ambitious. They're proposing acquiring 2% of Bitcoin's total supply.
Yeah.
That's what, roughly 420,000 BTC?
Wow.
Over the next 7 to 8 years? Now look, it's just a proposal at this stage. But it's a huge narrative shift, right? Moving Bitcoin from just being a speculative thing to potentially a strategic national asset.
Fascinating. Okay, and one more model. India seems to be pioneering a very accessible, localized compliance approach.
That's right. The trading platform Pi42 just launched the country's first crypto options trading service that settles directly in the local currency.
The Indian rupee, INR.
Exactly. Settling in rupees directly removes the foreign exchange risk, the conversion costs.
Yeah.
Makes it way more accessible for locals.
And the entry point is tiny, isn't it?
Incredibly so. The minimum contract size is just 10. That's about, what, 12 US cents?
12 cents. That dramatically lowers the barrier for potentially one of the world's largest retail markets.
Okay, now let's switch gears to the tech side. Because the structural maturity we're talking about, it isn't just about how Wall Street uses Bitcoin. It's also about how Bitcoin itself is expanding its own capabilities.
Right, a layer 2s.
Yeah, the competition heating up there is set to dramatically change what the network can actually do.
And we're seeing major upgrades happening almost simultaneously on the two big Bitcoin layer 2s, right? Creating this direct race. First, tell us about Rootstock.
So Rootstock, or RSK, that's the EVM-compatible layer 2, meaning it can run smart contracts written for Ethereum.
Okay.
They just activated a SegWit-supported bridge. Now, SegWit is a technical upgrade that makes Bitcoin transactions smaller, more efficient.
So what's the immediate impact for Rootstock users?
Efficiency. Peg-out fees, that's the cost to withdraw your Bitcoin back to the main chain, are expected to drop by up to 60%. That makes using it for DeFi, for decentralized finance, on Bitcoin, much cheaper and more practical.
60% reduction, that's significant. Okay, and then there's Stacks. They're focused more on security and speed, right? And they're nearing a big upgrade.
They are. They're in the final countdown for their major Nakamoto upgrade. It's a hard fork scheduled for Bitcoin block height, #, 867,867, which should be around October 29th.
And the key features there, what's the promise?
It's genuinely game-changing stuff. They're introducing fast blocks, aiming for much quicker confirmation speeds than the main Bitcoin chain. And the really big one, 100% Bitcoin finality.
Finality meaning it's irreversible.
Exactly.
Yeah.
Achieving 100% Bitcoin finality means a transaction confirmed on Stacks becomes just as secure, just as irreversible as a transaction written directly onto the Bitcoin base layer itself. That's a massive security guarantee for applications built on top.
So you put these two together, Rootstock getting cheaper and staying EVM compatible, Stacks getting faster and arguably more secure with this finality. It feels like the L2 conversation is now firmly in a results-driven competition.
Precisely. This isn't just theoretical promise anymore. These platforms are now actively competing for developer talent, for capital, for actual users. It's a crucial sign of maturity for the Bitcoin ecosystem.
But does it create new problems, like splitting everything up?
That's the challenge, yeah. We now risk fragmenting the Bitcoin DeFi ecosystem. You might have liquidity locked on Rootstock, different liquidity on Stacks, which highlights a future need for really efficient, reliable cross-L2 bridging solutions to kind of stitch it all back together.
No.
Hashtag outro.
So what does this all mean? You know, when we step back and look across the board, from the IBM security platform and that Goldman Sachs derivatives trade to the Securitize valuation and these big L2 tech leaps.
Yeah. The clear underlying trend is the market shifting. It's moving from just passive adoption, buying and holding Bitcoin in an ETF towards active utilization. People and institutions are starting to do things with this technology.
And we actually have hard proof of that active utilization happening right now. And it's coming from a very traditional source. You just need to look at Visa's latest earnings report.
Oh, interesting. What do they say?
They disclosed that the monthly volume for stablecoin settlement across the networks they support, it's now surpassed a $2.5 billion annualized run rate.
$2.5 billion.
Annualized. Yeah, and this isn't trading speculation. This is stablecoins being used as actual settlement infrastructure for real-world financial flows running through Visa's pipe.
Wow, that's real adoption.
It really is. And this accelerating pace of infrastructure build-out, by the giants, BlackRock, Goldman, DBS, IBM, Visa, it seems to be clearly outpacing the current regulatory frameworks, especially, like we said, when the regulators are literally shut down in the U.S.
Yeah, the builders are moving faster than the rule makers.
Which brings us to maybe a final provocative thought for you, the listener, to chew on. Given all this evidence, who is really setting the standards that are going to govern this new financial architecture? Is it the regulators, who often seem forced into a reactive position, sometimes by a political gridlock? Or is it the market builders themselves, the ones who are just, building the infrastructure anyway and pushing billions of dollars through it already? That feels like the core tension defining the future of finance right now.